Hey, this is Chris. Now, one of the big topics that our clients are asking us about at the moment is interest rates and inflation and what these mean for different types of investments. You know, does it mean they're going to go up or down, or do we not know? And so in this video, I'm going to be talking about 5 of the big asset classes, the big popular types of investments, and what you're likely to see in an environment of low but rising interest rates, which is what we're seeing at the moment. So the first asset is cash. Now, you'll all be aware that over the last few years, you haven't been able to earn a lot of money by parking your money in the bank. Interest rates have been very close to zero. Now, that's changed recently as the RBA has increased interest rates for the first time in several years from 0.1% to 0.35%. So as someone with money in the bank, what you're likely to see at some point is the interest rate on that cash start to go up. However, what we're seeing from the first few weeks after that RBA rate increase is that banks are pretty slow to pass on these rate increases. They're very quick to increase the rates for mortgage holders, but if you've got your money in the bank, you may or may not see these interest rate increases, but also they're expected to be rather gradual over time, and so you might see an extra 25 basis points this month, a little bit more the next month. You'll probably see these interest rates creep up gradually over time. So you will be able to earn a higher, a higher amount on your savings, but that won't happen suddenly. It will happen gradually over time. So that's cash. Term deposits is the next group, and really it's a pretty similar phenomenon. I think anyone that's been shopping around for term deposits over the last year or the last couple of years since the COVID market crisis will have really struggled to get much of a return. You know, you might have had to go to second-tier banks to get something better than the Big Four, and that's because banks weren't really in need of more capital. They had plenty available, and there were plenty of savers just parking their money in the bank. That's going to start to change, and we're already seeing term deposit rates start to increase. Now, the benefit of a term deposit versus cash is that a term deposit will actually reflect what's going to be happening in the future with interest rates to some extent, and so you might be able to already get a better term deposit rate because the market is actually pricing in interest rate increases continually over the next 6 and 12 months, and term deposits will start to reflect this. But what I'd say is you do need to shop around because not all term deposits will offer this immediately, and so you might need to haggle to get a really good term deposit rate. Keep in mind when you invest in a term deposit, there are often big costs to taking out your money early, so there is an opportunity cost of putting your money in a term deposit, which is that over that period, you can't be putting that money somewhere else. So if the share market suddenly has a big fall and you want to invest again, it's going to cost you a bit of money to get that out of the term deposit. It might still be worth it, but ultimately there's an extra cost. The next asset class is government bonds. Now this is one that's been a talk of the town this year because it's had its biggest move in decades. So government bonds, both in Australia and globally, have had a pretty significant fall in value over the first quarter of 2022. We're talking something like 8% in Australia and 11% from a global context. For share markets, that may seem like a normal sort of fall, but in bond markets, that's enormous. And what does this mean? Well, it means that government bonds now are reflecting the fact that markets are expecting interest rates to keep on ratcheting up. And government bonds with bonds that are graduating in 5, 6, 7 years are reflecting that interest rates, even as far as 2 years plus out, are expected to be over 3% in Australia. And so one of the benefits now of investing into government bonds versus a few months ago is that interest rates are already expected to be higher, and this is something you actually benefit from by owning a government bond. And if for some reason interest rates don't rise as quickly as anticipated, or they don't rise by as much, one of the big beneficiaries is government bonds. The downside of government bonds is, unlike cash and term deposits, they're more volatile. So it's not like you'll see your capital stay put and stay stable every day. Government bonds do go up and down based on mainly prevailing interest rates. And so even though you may earn a interest of something like 2.5% now over the next few years, you may see some volatility if you own it over that period of time. So that's government bonds. The next one is Australian shares. Now this is an interesting one. The Australian share market over the last 10 years has actually done pretty poorly compared to the rest of the world. But as 2022 has started, we've seen a big flippening where Australian shares have actually started to perform much better than global shares. And this is because globally and in Australia, the market is now pricing in higher inflation and higher interest rates. For a lot of global companies like technology companies, this isn't good news because a lot of their valuation is actually based on cash flows well into the future because they're high growth companies. Whereas in Australia, we've got a lot more companies like banks and resources where they are a lower PE ratio type companies. Most of their earnings are now or in the next few years rather than well into the future. Plus, for different reasons, they benefit from interest rates increasing. So banks tend to earn higher margins as interest rates are going up. And then commodity companies like BHP are benefiting because one of the contributing factors behind inflation is actually rising commodity prices. So compared to the rest of the world, Australian shares have actually done remarkably well this year. They're still down a little bit, but a lot less than global markets. If you look through periods of history where there has been higher inflation, our market here has typically done better than other global markets around the world. So where it's been pretty unpopular to own Aussie shares over the last 10 years, they may start to become more popular in an environment of rising interest rates and inflation. The other side of that is there are still sectors in our market that don't benefit from rising interest rates. Technology is one of them, but also the property or REIT sector in Australia doesn't tend to do well with rising interest rates and has actually underperformed so far this year based on expectations of interest rates going up. Which takes me to the next sector, which is actually property. So listed property companies have already suffered from the expectations of rising interest rates. We haven't yet seen that really trickle into residential properties, but intuitively you would expect that rising interest rates is not a positive for people owning residential property. Couple of reasons for this are, one, the cost of servicing debt is going to increase and people are able to afford less debt as a result of this. And secondly, property is really a long duration asset like bonds where a lot of the cash flow is actually well into the future. So if you own a residential property in Australia, you probably see right now that your rental yield or what you could earn in rent is pretty low, maybe 2 or 3%. As interest rates go up, people are going to demand a higher yield on these investments, but also all of those future cash flows that you might be earning 10 or 20 years out in rents aren't worth a lot if there's going to be a lot of inflation and higher interest rates between now and then. So property has started to fall in some of the major cities. You would expect that if interest rates are going to be 2 or 3%, which is where the market's anticipating at the moment, then it's not probably an asset class that's going to perform as well. And actually, we may see a change in leadership where over the last 10 years, property's done a lot better than shares. You might start to see shares do a bit better than property. And that brings me to the final asset class, which is global shares. Similar to Australian shares, it really depends on the market you're investing in. So for our clients, we invest in both developed markets, predominantly the US and Europe and Japan, as well as emerging markets, markets like China and India and Saudi Arabia and Brazil. What you tend to see in periods of higher interest rates and higher inflation is that developed markets like the US, particularly ones that have a lot of high growth and technology companies, don't do as well. They do better when inflation is low, whereas some of these commodity dependent economies and markets that a lot of the emerging markets fit into do quite well. So oil dependent economies like Central American economies and Saudi Arabia, Brazil that makes a lot of its revenue from iron ore. A lot of these countries actually tend to do well in periods of higher inflation and higher interest rates. Like we saw in the 1980s where emerging markets did better, and like we saw in 2003 to 2010 when emerging markets did very well. So although emerging markets haven't done so well so far this year, mainly because the Chinese market hasn't done well, they may be a market group that starts to do better in higher interest rate and higher inflation environment. But broadly, inflation and interest rates mean different things for different companies in different markets. And certainly in some of these big developed markets like the US, we've heard the negative stories so far this year, and it's certainly driven technology stocks a lot lower. So that's my summary of what could higher interest rates and higher inflation mean for the main asset classes in Australia going forward.